Usually when you look at a map, like a map of a city, right? Everything is just right there.
Yeah, it's all laid out for you.
Exactly. You see the highways, you see the bridges, the skyscrapers. It's all very visible. You can track exactly how a car gets from point A to point B.
Right.
But then you start looking at how money flows through the global economy, specifically into emerging markets, and suddenly that map just disappears.
It completely vanishes.
Right. We're looking at a financial landscape that is honestly entirely underground. I mean, the pipes are moving billions of dollars, but the valves are completely out of sight.
It is the absolute definition of hidden plumbing. And, today we've actually gotten our hands on a restricted intelligence briefing.
Yeah, the Luminant intelligence briefing.
Exactly. Cycle 01 published just a few weeks ago on April 30, 2026. And its blueprint reveals that the traditional map of global finance is, well, it's essentially obsolete at this point.
Which is wild.
It really is. The briefing synthesizes 38 specific signals across 24 different sources. So we're talking DeFi press releases, specialized African media, regulatory filings, layering all of this to spot patterns that surface-level news entirely misses.
And the mission for you listening right now is to really understand this massive hidden architectural shift happening at this very moment. It's changing how billions of dollars in development capital actually flow into Africa.
It's a monumental shift.
So we are going to act as your shortcut today. You don't need a finance degree for this. We're going to decode what this document calls the grammars of capital together.
I love that phrase, grammars of capital.
It's so good. Okay, let's unpack this. We all know the traditional playbook for a DFI, right? A development finance institution.
Right, the classic model.
They basically sit on a massive pile of government or taxpayer capital, and they write primary checks to spur growth. Their power was always measured by, the sheer size of their balance sheet.
Exactly. Yeah, but the Lumina briefing reveals they are transforming. They're pivoting from primary check writers into what the report calls mobilization engineers.
Mobilization engineers, that sounds like a huge structural change.
It is. If we connect this to the bigger picture, the goal is no longer about having the biggest balance sheet. It's about having the most credible balance sheet.
Wait, really? So it's not just a marketing rebrand?
No, not at all. We have to look at the math to see the scale of this pivot. The briefing points to a crucial data point from BII, British International Investment. In their 2026 to 2031 strategy, they explicitly codify this.
Okay.
They're aiming to take 5 billion pounds of their own commitments and engineer that into 9 billion pounds total. And they're doing that by improving their mobilization ratio by 40%.
Oh, wow. So they're mathematically committing to having less skin in the game, but wielding more influence.
That's exactly it.
It reminds me of throwing a massive party.
Okay, I like where this is going.
Right. So traditionally, a DFI was the host who bought all the food, rented the tent, paid for the DJ totally out of their own pocket.
Right. They funded the whole thing.
Exactly. But now, as a mobilization engineer, they use their VIP reputation to get a world-class venue for free. And then they use that underwriting credibility to convince everyone else to bring the catering and the entertainment.
That analogy captures the mechanics perfectly. This is an operational and structural transformation. They are physically building the pipes to channel third-party money.
So they're building the pipes. How exactly are they doing that?
Well, the briefing moves from this high-level theory into the actual plumbing. It maps out 4 distinct mechanical forms, these grammars of capital, that have emerged over the last 18 months.
Okay, let's go through them. The first mechanism they identify is a vehicle called Zafiri, right?
Yes, Zafiri.
So Zafiri is a permanent capital vehicle for distributed renewable energy. It launched with $300 million, backed by the IFC, the African Development Bank, and the Rockefeller Foundation. And it has a $1 billion target.
Which is massive.
Right. But the structural key here is the phrase permanent capital. Because, in traditional private equity, you have an 8 to 12-year vintage horizon. You invest, and a decade later, there is immense pressure to exit, sell the company, and return the cash.
Exactly. Which is terrible for infrastructure.
Right, and Zafiri entirely removes that exit pressure. It uses cash flow recycling and dividend distribution instead.
What's fascinating here is, imagine building a national solar grid, but having a legal obligation to liquidate your position in year 10 just because a fund's clock ran out.
That makes literally zero sense.
It makes no sense at all. Zafiri allows the capital to stay in the ecosystem indefinitely. The dividends generated by the solar grids are simply recycled back into funding new grids. It matches the financial timeline to the reality of the physical infrastructure.
Okay, so Zafiri solves the timeline issue for massive long-term grids. But what about the friction of funding a dozen tiny off-grid startups? You can't really use a massive prominent capital vehicle for that.
No, you need something much more agile.
Which leads to the second grammar of capital, a revolving facility called DARES.
Right.
The IFC and Norfund committed roughly $83.2 million across 5 Nigerian off-grid energy companies simultaneously. I think it was Darway Coast, UVE Projects, Prado Power, Pravida Power, and StarTimes Energy.
Yes, all 5 of them in a single cohort.
But wait, I have to push back on the novelty here. Isn't DARES just a bundled loan? I mean, commercial banks have been syndicating loans for decades. How is this fundamentally different?
That is the exact right question to ask. The non-equivalence here, what makes it different from traditional DFI behavior or just a standard bank loan, is the operational overhead shift.
Okay, walk me through that.
A traditional DFI evaluates and funds one project at a time. So going through 5 different legal committees and underwriting processes for 5 separate microgrid startups is incredibly high friction.
Tons of paperwork, tons of billable hours.
Exactly. DARES shifts that overhead. These 5 Nigerian companies are aggregated into a single cohort that relies on a shared, revolving credit line. As one company pays down its portion, the money cycles into new commitments within that exact same legal structure.
Oh, I see.
Yeah. So companies don't compete project by project in an open market anymore. They compete to get into the curated cohort, which then guarantees them ongoing liquidity.
That is so smart. And that aggregation concept actually leads directly into the third structural shift the briefing identifies, right? The institutional aggregator.
Yes. This one is huge.
The example here is a joint transaction between BII and a Dutch firm called ILX. They are pooling Dutch pension and insurance capital to fund micro, small, and medium enterprises in East Africa.
Think about the mechanical gears turning behind the scenes at a Dutch pension fund, right?
Mm-hmm.
They manage billions of euros, and they desperately need the yield that emerging markets offer.
Because European yields are just too low.
It's exactly. But their risk departments and European regulators will not allow them to directly lend to, say, a small agribusiness in Kenya. They lack the localized underwriting capacity to assess that specific risk.
Right. They just don't have the boots on the ground. But they do have deep trust in a DFI like BII.
Precisely. So the DFI is stepping in to provide what the report calls a structural halo.
A structural halo, like a first loss guarantee.
Yeah, a first loss guarantee or a blended finance stack that essentially absorbs the initial shock if the investment goes south. The report frames this as a protection transfer.
Oh, wow. So the DFI's underwriting credibility acts as a shield.
Right, mathematically satisfying the European regulators' risk requirements. ILX then acts as the aggregator that actually pools the pension money and funnels it through this protected pipe.
So again, the DFI isn't deploying its own capital primarily. It is routing third-party institutional capital that otherwise would have been trapped in Europe.
Exactly. They're engineering the mobilization.
Which brings us to the fourth grammar, and I think it's one of the most subtle ones, co-branded programming.
This one really surprised me.
Right. The intelligence briefing looks at FMO and DII co-hosting a climate summit at the Super Return Africa conference. And honestly, when I first read this, I assumed it was just a typical industry conference panel, people wearing lanyards, handing out business cards.
Right, just a standard networking event.
Exactly. But the briefing categorizes this as actual coordination infrastructure.
Because it is. When 2 major, historically competitive DFIs co-brand a massive industry summit, they are institutionalizing their coordination.
They're sending a signal.
A huge signal. They are publicly telling the entire market exactly which themes, sectors, and geographic regions are going to receive this newly mobilized capital.
It sets the menu for the private market. It tells commercial banks and private equity exactly where those structural halos will be placed over the next 12 months.
Exactly. It's a coordination mechanism, not just a party.
Okay, so we've mapped out these 4 new pipelines. We've got the permanent capital recycling with Zafiri, the revolving cohorts like DARES, the institutional aggregators with their protection transfers, and the public signaling summits.
Right. The new plumbing.
So the next logical question for you listening is, who actually controls the valves on these pipes?
And this is where the power dynamics really shift.
The report introduces a fascinating dynamic called the C5 Anger Insight. It suggests DFIs are fusing 2 roles together, the feeder role, the one providing the capital, and the gatekeeper role, the one selecting the channels.
Yes. And as a result of that fusion, they are elevating a very specific group of general partners, or GPs.
The fund managers.
Exactly. These appointed fund managers are being turned into structural intermediation nodes. Because the DFIs are controlling so much mobilized third-party capital, the few GPs they select to manage these funds become incredibly powerful. They basically become toll booths in the African market.
Here's where it gets really interesting. The briefing gives a very specific asset tracing example to back this up.
The inspired evolution case.
Right, look at Inspired Evolution. They're a fund manager in Cape Town with about $850 million in assets under management. The report tracks that Inspired Evolution was appointed to manage that Zafiri permanent capital vehicle we mentioned earlier.
Right, the big solar fund.
Yeah. And in the exact same week, Inspired Evolution exited their controlling stake in a portfolio company called CISA, precisely as Vantage Capital entered that same company with mezzanine financing.
The timing is incredible.
So picture this cross-deal asset tracing. Are we looking at a total coincidence here, or is this undeniable proof of a newly minted elite class of anointed fund managers acting as toll booths for DFI capital?
Well, the briefing evaluates this impartially, which is great.
Yeah.
It acknowledges the entirely plausible scenario that this is just a track record-driven coincidence.
Like Inspired Evolution just happens to be really good at what they do.
Exactly. They have a stellar history, so they naturally won the Zafiri mandate.
Yeah.
And exiting a company at year 7 while another player enters with mezzanine debt is, standard portfolio rotation.
Sure. But the timing of the cross-deal flow is what makes it look like a closed-loop ecosystem.
Right. And the structural reality is that there is virtually no equivalent capital formation pathway for GPs outside of this DFI selection process.
Oh, wow. So if you're not in the club, you're out in the cold.
Basically, yes. If a GP does not get anointed by a DFI to manage one of these massive mobilization vehicles, they face a severe structural disadvantage. The power to pick market winners has been intensely concentrated at the DFI strategy committee level. They are the ones deciding which GPs get to hold the keys to the new plumbing.
That is a massive consolidation of power. Okay, but so far we've focused heavily on foreign DFIs, European pension funds, and the GPs they anoint. What about local African institutional capital? Are they actively shaping this new architecture, or are they just operating as pawns within it?
Well, the briefing cites an industry report from AVCA, the African Private Capital Association, showing that 21% of private capital fundraising in Africa is now originating from domestic limited partners.
21%. I mean, on the surface, that metric looks like a massive triumph for African capital sovereignty. It suggests local wealth is funding local growth.
Right, but the briefing counters that narrative with what it calls the Truth for hypothesis.
And what does that say?
It notes that in the data they scanned, visible African pension capital-like Axis Pension Trust, co-investing with Norfund in Ghana, for example, only appears in the form of what they call saplings.
Saplings, like small trees.
Yeah. They are acting as passive co-investors following the terms, timelines, and structures set by the foreign DFIs. So they are being absorbed into the DFI architecture rather than operating as institutional peers demanding their own terms.
Wait, I have to push back on the intelligence report itself here, because they admit something pretty huge.
Yes, they do.
The report explicitly states that for this specific intelligence cycle, they did not scrape the local African regulatory databases. They completely bypassed the FSCA in South Africa and PENCOM in Nigeria. So the report is basically admitting it might be completely wrong about African capital because it didn't look in the right file cabinet.
Exactly. And honestly, this raises an important point about the document's intellectual honesty, that admission is a strength, not a weakness.
Really? How so?
Well, especially when you consider that South Africa's Public Investment Corporation, the PIC, has something like 2.6 trillion rand in assets under management.
That is a staggering amount of money.
Right. So the analysts recognize the critical difference between African capital being absorbed into DFI structures versus the parallel building of massive unseen sovereign wealth architecture operating completely independently of European aid. By flagging this blind spot, they explicitly define the data they must pull in Cycle 02 to find out.
Okay, that makes sense. They know what they don't know. Now, speaking of alternative explanations, we need to dive into the plot twist of this entire document.
The Phase 5 counter-reading.
Yes. Up until now, we've analyzed this entire architecture, the mobilization engineering, the cash flow recycling, the protection transfers, under the assumption that it was born from a genius strategic pivot by forward-thinking institutions.
Right, that they are visionary.
Exactly. But the intelligence framework requires the analysts to attack their own conclusions. They propose an alternative causality. What if this isn't autonomous strategic reengineering at all? What if it is a defensive reporting architecture innovation forced by intense political and fiscal pressure?
To understand this counter-reading, we have to look impartially at the macroeconomic and political realities of the donor countries funding these institutions. And we're just reporting what's in the briefing here, but the fiscal pressures are very real.
Right.
For example, the UK has progressively cut its official development assistance from 0.7% of its gross national income down to 0.5 and then to 0.3. The Netherlands is navigating significant budget contractions. In the U.S., there are ongoing debates about restructuring or dismantling parts of USAID.
So, under this alternative lens, BII's goal to improve their mobilization ratio by 40% is not a visionary strategy to reshape global finance. It is a strictly defensive metric.
Yes.
It was engineered to appease treasury ministries back home who are demanding absolute value for money in a rapidly shrinking aid environment. It's the difference between renovating your house because you love open concept living versus knocking down walls and renting out a room because the bank is threatening to foreclose and you need the cash flow to survive.
That is a perfect analogy. The Treasury departments in Europe are demanding proof that taxpayer money is being stretched to its absolute limit. In response, the DFIs invent these four mobilization mechanisms, not necessarily to revolutionize the market, but to generate a reportable headline.
A headline that says, for every single pound of taxpayer money we spent, we mobilized 2 pounds of private institutional money. Please do not cut our operating budget.
Exactly. And the fascinating part is that both theories, the genius strategic pivot and the defensive political scramble, fit the exact same data perfectly.
That's crazy.
The mechanisms exist, the money is moving, the GPs are acting as toll booths, but the fundamental causality driving the behavior is completely different.
So, what does this all mean? We have two perfectly logical, diametrically opposed explanations for the exact same reality. How does an intelligence framework figure out the truth moving forward?
Well, the briefing draws lines in the sand with something called falsifiable probes. They state exactly what future events will prove them right or wrong.
Okay, let's look at those. Probe 1 is all about BII's upcoming FY26 report, dropping in September or October of 2026.
Right.
I noticed the analysts are basically setting a language trap here. They are going to analyze the specific framing BII uses. If the report describes this mobilization ratio as a grand foundational strategy for the future of finance, it supports the visionary theory. But if they use language framing it purely as a government efficiency metric, the jig is up.
Exactly. They're also tracking the physical recurrence of these financial channels. Probe 2 looks directly at the BII and ILX institutional aggregator.
The one routing the Dutch pension money.
Right. If this represents a real foundational strategy, the market will see a second similar deal executed within 6 months. The behavior will recur. If it is merely a political showcase designed to be printed in a brochure for the Treasury Department, the channel will go completely dormant.
It's just a one-off PR stunt.
Precisely.
I found Probe 5 to be the most revealing test, though. It expands the scope to Asia. The report assumes Africa is currently the vanguard of this mobilization engineering. But the analysts haven't scanned the Asian DFIs yet, like the Asian Development Bank or JICA in Japan. If they scan Asia in the next cycle and find the exact same permanent capital vehicles and revolving facilities being deployed, it proves this is a global, coordinated architectural strategy. But if Asia is operating business as usual, it heavily supports the fiscal pressure theory, because the political pressure to aggressively cut aid budgets is highly concentrated in Europe right now, not Asia.
This is the beauty of this analytical framework. It doesn't claim to be omniscient. It lays out the structure, presents the two underlying possibilities, and says, here is exactly how reality will prove me wrong by October 2026.
So which timeline do you think we are living in? The strategic masterclass or the political scramble? It really is the difference between just summarizing the news and building a framework to test reality.
It absolutely is.
Let's briefly recap the terrain we've covered today. We started with the fundamental shift of DFIs abandoning their roles as primary lenders to become mobilization engineers. We unpacked the mechanics of the 4 new pipelines, permanent vehicles replacing decade-long exits, revolving cohorts shifting operational overhead, institutional aggregators providing protection transfers, and summits acting as public signaling infrastructure.
Right. The four grammars.
Then we looked at the hidden power dynamics of GP gatekeepers controlling the valves. We uncovered the massive data blind spots regarding local African sovereign wealth. And finally, we wrestled with the tension of whether this entire underground map was drafted by strategic vision or short-term budget cuts.
Understanding this hidden infrastructure really provides a completely different lens for evaluating every piece of financial news emerging from these markets from this point forward. You're no longer just looking at the surface level announcements, you're looking at the plumbing.
You are armed with the hidden map. But before we wrap up, I want to leave you with one final provocative thought that builds on this new reality. Something that wasn't explicitly discussed in the sources, but follows logically.
Oh, interesting. What is it?
Well, if these DFIs are so wildly successful at acting as protection nodes, if they do a flawless job of underwriting third-party institutional capital and shielding those Dutch pension funds from emerging market risk, what happens in a decade? What happens when those global limited partners finally develop the internal capacity to feel comfortable assessing African market risks on their own? By building these perfect frictionless mobilization engines, are DFIs ultimately engineering themselves out of existence?
Oh, wow. That is the ultimate paradox of development finance.
Mhm.
If they build the perfect bridge for private capital, the market no longer needs the architect. Success might mathematically equate to obsolescence.
Yeah. Exactly. We started by talking about the hidden plumbing beneath the city, the pipes, the valves, the underground rivers of capital. Today we opened a manhole cover and took a hard look down there. The water is definitely flowing, but the real question is who will control the valves tomorrow. Thank you for joining us on this deep dive. Until next time.